Welcome to the Invest for More Real Estate Podcast. My name is Mark Ferguson, and I am your host. I'm a house flipper. I flip 10 to 15 houses a year. I own 13 rental properties with a goal to buy 100 by 2023. I'm also a real estate agent. I've been licensed since '01. I run a team of 9. We sell close to 200 houses a year. So on this show, we like to interview house flippers, landlords, and the best real estate agents in the business. So stay tuned for some great shows. If you want more information on my rentals, on the numbers, how I buy properties, check out investformore.com. I have an awesome guest today, Michael Blank, who has a very interesting history. Software programmer, part of a software company, has owned restaurants, has invested in many multifamily properties, has flipped houses, and has even done a little bit of commercial stuff. So we're going to talk about Michael, about his history, how he got started, some tips, some things he's learned along the way as far as investing in multifamily, raising private money, and maybe a few tips if anybody wants to start a restaurant too. So Michael, great to have you. Thanks for being on the show. How are you doing?
Good, Mark. Thanks a lot. I appreciate it.
Oh, yeah, no problem. I found your bio really interesting, so I'm glad you're on. The first thing I always ask my guests is, how they got started in real estate. What was the first steps they took? I know you were a software person, you're in that field, and then you tell us, how did you get started in real estate from that stage?
I did what everybody else should do, and I got a master's in computer science. So, right, that's what everybody else should do. So that's, how I prepared for it. So I had no plans early on. I did what I was told, which is go get good grades, get a good job with benefits. And I did, though, want to experience a software startup. And so after several years out of college, I did actually join a software startup. And this was in the late 90s, right place, right time. Was one of the very early employees there. And we eventually went public in 3 years, grew it from 0 to 200 million revenue. We had offices worldwide and put a bunch of money in my pocket, which was awesome. And so, yeah.
That's how everybody wants to start, right?
Yeah. So life is great. I'm, young, just got married and I'm, whatever. It's great. And then this was now in 2004, I read Rich Dad, Poor Dad. And I'm like, I am such an idiot. It doesn't matter what I have in my bank account. Is if I stop working tomorrow, the money stops flowing. And that just didn't appeal to me. So initially my plan was to have my own software company. So before this, I had moved around inside my company within marketing and also in sales at the very end, which was the toughest job I've ever done, by the way, is to sell stuff. Learned a lot. Anyway, so read Rich Dad, Poor Dad, really reflected on what I want to do next. And I said, you know what? I think I'm going to can my entire graduate, career and all that stuff. And I'm going to do the Rich Dad, Poor Dad thing. And, so I did two things at the same time because I basically quit my job at that point. And I had all this money in the bank. So, I had the time. And so I focused. The cash flow business for me was restaurants. I knew some people who got into a franchise, very popular franchise at the time. And they were like, yeah, you hire a guy to run all these restaurants. You just build them out and you sit back and you count the passive income. I was like, that's great. That's exactly what I want. I don't know anything about restaurants. Doesn't matter. Let's do it. And on the real estate side, I decided to flip houses. So I aligned myself with a local mentor. And at the time, this was 2005-06, the market was red hot. So we're sending out postcards. That's what we're doing. We weren't looking at MLS postcards, sending up the 800 number, taking the calls. And I flipped a few houses and I did 2 houses that made more than my entire salary at this company. I was like, wow, that is just mind blowing. And so I did a few more of those, kind of did it on the side. Finally, we got started with the restaurants. Got very busy on the restaurants. I decided I wanted to get into commercial real estate. So I went to a boot camp and started marketing in Texas and starting out letters and brokers and building teams. I must have looked like 100 deals, I swear. Hours and hours of crunching numbers and spreadsheets and making offers. And finally, I had an 82 unit under contract. And I had it under contract for like 1 day because I thought about it. It's like, oh my gosh, if I play this thing out, I'm going to have to be in Texas, for days on end. And we just built 2 restaurants and we were buying a restaurant. It was nuts. Like there's only so many hours in a day. So I need to pick. I need to choose. And I was already so heavily invested in restaurants. So I put the whole real estate thing, on hold for all of 2006, 7, and 8. So it makes me look like a genius that I missed the entire recession. But it bit me on the butt on the restaurant side. I mean, no one came out unscathed in that time. And then 2009, I decided things kind of stabilized, and I got into house flipping full bore, not just a hobby, but as a business. And it was quite a bit different. I deployed almost an entire net worth in these restaurants. I had a 20-unit plan in my brain. I had a whole business plan worked out. Didn't work out that way, but my whole plan was 20 units. I'll buy, I'll put all my net worth in these 3, 4, whatever restaurants, and that will carry me forward. That'll be my core business, and I'll expand from that. That was my kind of grandmaster plan. So I was essentially semi-retired at that time doing these restaurants and counting my passive income, and got into flipping houses, but I had none of my own capital. So the only way I could do it was to raise it. And I had raised money from friends and family, a substantial amount of money. And we had about, 25, we did about 30 properties in 3 years. And it was a lot. And that was the first time I got the taste for other people's money. And it was only because I had none of my own anymore. It was all deployed. And I was like, wow, the raising money thing is mind blowing. It's mind blowing. And I did eventually get into the commercial space and bought a small 12-unit building in Washington, D.C. And that was my first syndicated deal, which means that private placement memorandum, subscription agreements, operating agreement, and it really kind of did it the right way. And then a couple of years later, I did the same thing for 2 restaurants. So I syndicated the purchase of 2 restaurants, and currently have investors looking for additional deals. And I've really done a lot of different things. My focus currently is really apartment buildings, and I've been getting out of the restaurant business and divesting myself of that, and really focused 100% on apartment buildings.
Very cool. Very cool. Yeah, you talked a lot of different things there. So, but one thing I want to get into before we get into the real estate side, I've always had a dream of opening a pizza restaurant myself. I mean, not really because of the money, but I like to make pizza. So I know it doesn't really make sense to make a pizza restaurant because of that. But tell me, what was the biggest challenge you had and the biggest thing that surprised you in the restaurant industry?
So here's the thing. I got in the restaurant business without really having any restaurant experience. And it was okay at the time because I wasn't actually running the restaurants. The only thing I did is write checks, and I did the marketing because I'm pretty good at marketing, but I hired a guy to run all these restaurants, right? So the lesson on the one hand is, align yourself with people who know what they're doing if you don't. That's the lesson number 1. Lesson number 2, though, is don't get into an investment that you're not afraid to run one day. And that's kind of what happened to me. Because when the business stopped performing, I couldn't afford my guy anymore, and I had to let him go, which means now I'm running 6 restaurants. Well, not only did I not really know much about restaurants, but I didn't really want to run 6 restaurants. And so there was lessons all around in that. And, I've always known that I'm not a restaurant guy. I enjoy the marketing, and I enjoy actually interacting with people and getting them to perform better and to realize their full potential. I love that, but I don't love the actual restaurant operations. So I guess, it's the same thing for real estate, really. I mean, do you really have to love the real estate part of it? Not really, but it helps. Okay, it helps. The advantage on the real estate, especially on the apartment buildings, if first of all, you have a property manager built into the business model. You don't have that built into restaurants necessarily. You have to make sure that the opportunity allows for it. But with apartment buildings, it's already built in the business model. Most everybody does it. And if they don't perform, you find someone else. It's not like you're going to be collecting rents yourself on a 30-unit building. So that can't happen, or is less likely to happen on the multifamily front than any other business that you own.
Right. Well, I imagine if you're looking to find someone to manage 6 restaurants versus a property manager to manage an apartment building, it's a little easier to find a property manager than someone with restaurant experience.
Yep, so. Exactly. A restaurant is a very complex business. It really is. And you have to know what you're doing, but you also have to have the heart for it and the passion for it. And there are people who really love it. And if you're that kind of person, it's good for you. If not, maybe you should rethink the investment.
Right. No, it makes total sense. Yep. So you went from the restaurant business to flipping houses. That's a lot of flips, 30 properties in about 3 years or so. I'm curious, we've talked to a lot of flippers. one big surprise was you made so much money on your first deal, because so many people end up losing money, or, it becomes an education process instead of a profit process.
Oh,
But
I lost money. Don't get me wrong. It was not on those first two though. It was like deal, 17, which is good. If you lose money in your first deal, you're probably not going to do the second. It's just my guess. You're like, that sucked. I'm not doing that again.
Right. Yeah, no, it makes it tough. So when you're doing those properties, what was your biggest challenge flipping? Was it finding contractors, or like you said, was it finding the money?
No, finding the money was actually relatively easy. And the reason was because it's single family houses. People know and understand single family houses. It was a relatively small amount of money, $25,000. It was a simple transaction. They got a promissory note that the title company handled. So it's $25,000 in, secured by real estate, 6-month hold, very short time, and 12% interest. Everything was right. It was an easily understood investment, low risk, high reward, complexity low. People said yes. Okay. The apartment side and restaurant side, raising money for them was much more of a challenge. But so the money raising side, what surprised me, the money raising side was actually easy on the single family house. What we struggled with is definitely, as you pointed out, is the contracting side. So I had actually hired sort of a project manager. It was a contractor that did one of my houses, and he said, "Why don't we work closer together? We'll put together a comp plan. You manage all of the construction side." And it was too many months into it until I realized that this guy was in it way over his head. He was a great contractor, but it really had no people or administrative skills, which you kind of need if you're managing other people. And really, it was we never really didn't make as much money as we should have, and we lost some money as well because of it, until I found the right guy. The right guy that had the capacity, that communicated well, had good people skills. And it's all about the people you have around you, right? As you know, you have some that you find you're having to micromanage. And I tend to do this more than others. I'm like, I can make you be the person you can really be. I'm going to work with you. I'm going to make you my project. And I've done this so many times now that I'm like, stop that. Okay. You probably have the wrong person. Now you're obviously you want to further someone, but when you're micromanaging someone, it's not a good sign. So this guy did not have to be micromanaged, and life was quite a bit different. So definitely having a strong contracting team around you is critical.
Nice. No, I've got 11 flips going right now, and I hired.
It's a lot.
Yeah, it is. It's a lot, and it's tough to do that. I hired a project manager, just like you said, earlier this year. He is one of my contractors, but he also had a management background in the corporate world. So it's going slower than I thought it would, getting things in place, but it's moving along. So I'm hoping next year things will be much smoother. We've got the processes down, but yeah, trying to do all that myself I was trying to do it myself before, and I was taking up to a year to flip properties because just managing the contractors and getting them done, it was insane.
It was insane, right?
Yeah. So tell me more about the private money. How did you structure these deals and allow people to buy in for $25,000 at 12%?
Right. So I thought it was a very complicated process in the beginning, but really it's much simpler. So here's how it works. You get your verbal commitments from your investors. Okay. They then essentially wire the money to the title company, and they in turn get promissory notes that you sign at closing. So they put the money in escrow, and they in return get promissory notes, and those are recorded on the deed, right? So if you have multiple investors on there, let's say 5 or 6, they're all listed on the deed, right? So I couldn't sell the house and not pay the money back. It's all in the deed, and if it's a different title company and I'm selling it, they see it on the deed and it references the promissory notes. They have to disperse those it's just like a bank, essentially, just like the bank. So they're protected, right? There's profession. It's a well understood process. But I found that not every title company understood the process. So it's not like every title company, they'll look at you and it's like, I don't know how to do, you can't do that. So you have to have a title company that understands that, but it's otherwise a very well understood, very simple process. Yeah, and so that's how we structured it. And it was basically a simple promissory note, 12% interest per year. And when you sold it was a payoff. You calculate the interest accrued to that point and you pay it out.
Nice. Now, were you able to finance repairs, like the whole purchase price of these properties, or were you bringing your own money into it too?
No, you raise as much money for the purchase price, closing costs, and the repairs. And in the beginning, I wasn't raising quite enough. So I would for example, if a project ran over, I had to put my own money in. So I raised a little bit more the next time around. So you have maybe raised a little bit, $10,000 more than you need in case there's an overrun. So that's probably a good thing to do.
Very nice. Very nice.
Yep.
Now, did your investors have a problem with there being, or price point these properties were at, but like, having 4 or 5 different people on the same property, or did they, trust you, trust the process and just go forward with it?
Yeah, that's a good point. I mean, these are friends and family, acquaintance kind of people. And I guess maybe they trusted me, but I think it's a good point. I mean, in a default situation, theoretically, if there's 5, investors on a deed, how do you foreclose on the property? You have to know who the others are. They have to organize, and you have to agree. And it basically would be a nightmare, right? So this is why a hard money lender will never agree to share the note with anybody because of that. But these are not sophisticated investors, right? These are friends and family acquaintances, and they essentially trust you that you're going to do the right thing. Yeah, you're right. I mean, like a hard money lender would not agree to that.
No, I think that's just a good point, that when you're getting private money, there's a lot of these companies popping up that claim to be private money online and across the web. And what they really are is hard money disguised to be private money to try and attract more people. But real private money is what you said, friends, family, acquaintances, people you've met along the way who are just personally basically giving you money and you give them a return.
Right. I mean, hard money, I've done pseudo hard money early on. There was a sophisticated investor who basically behaved like a hard money lender. And those are hard because, as you know, the term is normally 6 months. And if things go longer, you can get into trouble. And a lot of hard money lenders are very heavy handed, and they'll just start the foreclosure process on you. In my case, when something took longer, and in one case, it took significantly longer, like 6 months longer on one project. One took like 8 months longer. So this was like 14 months total. In that case, I just called my investors, hey, look, I need an extension. You're going to get more interest. Here's an addendum to the note that extends the note by 6 months. They're like, okay. And then everything's fine, Whereas a hard money lender will start calling you every single week, and they'll start getting involved. And hey, and you're going to start looking and see what's going on. So private money, in the traditional sense, is actually superior to hard money. With a little extra work, it's much better.
Oh yeah, completely agree.
Yeah.
So what steps did you go through to find this private money, and how did you pitch your projects to them? Was it difficult asking friends and family for money?
In the beginning it was, and I struggled a little bit by asking friends and family who, I might see for Thanksgiving, for example. I was like, and I had people still ask me to this day, I don't take friends and family money. I'm like, really? Wow, you just cut off 90% of your sphere of influence if you do that. If you understand it better, they're afraid that they're going to lose someone else's money. Okay, fine. I get that. But even if you lose a stranger's money, you're still losing someone else's money. So really, the spectrum it's really not there. It depends on, to answer your original question, how do you approach people? It depends on where you are in your experience level. If you have a track record, then you can put together a portfolio, before and after pictures. And that was extremely useful, when you have, half dozen, you can show before and after pictures and what you bought it at and how much money you made. People go, that's cool. This guy knows what he's talking about. In the beginning, though, you don't have that. And so what do? So what I did is I made up a portfolio, and I basically I went and looked at houses and put together essentially a business plan for a house. So I went and looked at one, got the MLS, looked at the house, took photos, put together photos, and then put my scope of work, how much it's going to cost, have the comps together, and how much it's going to cost, a whole business plan for this house. And it said, this is what I'm going to do. I don't have this on the contract, but when I do, it's going to look just like that. And people look at that and go, oh, yeah, this guy knows what he's doing. I see what he's doing. He's got the comps. And it at least allows you to build some level of credibility until you get that first or second success story.
Nice. And, well, you said something really important, too, in that you had the comps, you had the numbers, you could show them, I can buy it for this. I have this much in repairs. It'll sell for this. I hear a lot of people trying to pitch private money, go look for funding, and they don't know those numbers. They say, oh, I've got this deal, it's 60,000 and, I think it's worth somewhere between 140 and 180. It's like, well, what are the repairs? What are the, what's right. They don't know. And it's like, you have to know as much as possible to convince someone you know what you're talking about.
That's right.
Cool. So you went from the flips, still had the restaurants at that time, and then you went looking into the multifamily commercial space. What made you want to jump into that space as opposed to single family?
Well, my plan always was commercial real estate, apartment buildings, buy and hold, long-term wealth creation. That's when I got started in 2007, went out to boot camp, and I was hot and heavy for about 9 months. I mean, really spent a lot of time analyzing deals, building the team, sending letters. And then, like I said, I put that on hold. That was my initial plan. The reason I really got into more flipping is because the market was so unique in 2009, 10, and 11. We had so many foreclosures, such a supply of cheap property. And then in our area, in the Washington, D.C. area, as many part of the country, the retail market was recovering so quickly so that the spread was enormous, okay? And there was not a lot of people doing it, and it was very easy to get property and very easy to sell. And so I knew it was a narrow window of opportunity that I felt I needed to take advantage of. And I put my multi-unit on hold a little bit until finally, I started taking action on it. But really, that's been my plan all along. I think there's a lot of people who feel like they need to go the single family route first before they can graduate to apartment buildings. And looking back on it, I don't actually think that's necessary. In fact, depending on what your goals are, it could be a major distraction.
Okay, cool. So now I've got my 16 rentals. They're all single family except for one kind of up-down duplex, which is pretty much a single family anyway. What attracts you to multifamily more than single family? And it's okay if you disagree with me. I'm okay with that. But
I hear, Mark. Here's the thing. It all depends on what your goals are, and sometimes you can have the same goal and you can get there different ways. But so I'll approach it for what are your goals and how do you achieve your goals. So let's say your goal is that you want to be able to retire in 3 to 5 years or whatever the case may be, meaning that you need enough passive income off of something to quit your day job, let's say, and you decide that you need, I'll make it up, $7,000 a month. And now you figure out, how am I going to use real estate to accomplish that? And you start looking in single family houses because that's what everybody thinks and starts off. And you say, well, I can maybe in my area buy a house, and after all expenses, maybe I can make $200 or so per month. And you divide that number into 7,000. And I can't do math in my head, but it's a pretty large number of houses that you would need. Then you start thinking to yourself, oh, shoot, that's a lot of houses that I need. Am I going to get there in the kind of time frame I want? Or maybe I'm on I'm going to do 1 or 2 houses a year, and I'll get there in, say, 15 years or something like that. And that's fine. The one deal per year strategy is a fantastic retirement strategy. Or do I want to try to get there faster? And if you want to get there faster, single family houses, you're going to have a challenge with that because it's a lot of transactions versus if you buy, if you decide that you need to control 100 units, let's say, using private money to make $7,000 per month, I can probably get there in maybe 2 or 3 deals versus 100 individual houses. I maybe do my first 15 unit, then I do a 25 unit, and then I do whatever is left, a 50 unit after that. So I'm in there in 3 hops versus 100 individual hops. On the other hand, though, it's harder to buy apartment buildings. You need more capital. It's hard to find the deals. It's easier to get the capital through single family houses, and it's easier to do deals. So I know guys who specifically have portfolios of rental property, and they raise money for that because that's what's working right now, and that's the strategy they chose, and the strategy is fine. But I think a lot of people, they don't really think about what their goal is and the timeframes they want, and they feel like they need to go through the single family route to get to where you really want to go, and that's a huge myth. And if someone really wants to get to multifamily apartments for for passive income, long-term wealth creation, they don't need to do single family house. It actually doesn't really buy them as much as I thought it would. I thought when I flipped the houses, it'd be a shoe-in to go into apartments, but of the 30 investors, I think only 1 or maybe 2 actually went with me the apartment side. Everybody else said, nah, not for me. Forget about it. Then when I talk to the brokers, I say, I flipped 30 houses and now I'm, going to buy your building. They're like, yeah, but how many apartments have you done? I'm like, well, none, but I did 30 houses. And they're like, yeah, you're a newbie. And I got very little credit for my house flipping career. I mean, all my portfolio that I built up, my nice, pretty pictures, didn't really buy me anything. So I'm like, well, shoot. Everybody told me, or I thought that this would let me get in there more, easier. And it was actually not the case. And I realize now that the reason people think they have to go to a single family house is to expand their minds to get more comfortable with it. But there's actually other ways to do the same thing without actually going through single family houses.
Right. No, that makes perfect sense. And when I say I invest in single family, I always tell people too, that doesn't mean that's the only way to do it. That doesn't mean it's better than multifamily. But I think in my particular market in Colorado, I can make more money on single family than multi because our cap rate is like 5% on multifamily and there's nothing available. But if you're in somewhere else with more multifamily or better cap rates, it can definitely make more money than single family.
Yeah, that's exactly right. And so you're trying to achieve the same goal with a strategy that's working where you are. And if you try to pursue, for example, multifamily in a hot market like San Francisco or Boston, whatever else, it might take you a very long time to get there, unless you're willing to invest in other markets, which is always an alternative. But you say, hey, I want to stay local. I don't want to hop on a plane and do something remotely. I'll do something here. So you thought about this. And what I'm saying is I'm finding a lot of people don't actually think about this in a lot of detail. They just do it kind of without thinking because that's what everybody tells them to do. But I'm just saying you got to think through the strategy and make sure it aligns with your goals.
Yeah, no, that makes perfect sense. You said one interesting thing too. It's much harder to buy large multifamily apartment complexes. I imagine it's harder to raise private money for them too. How did that process differ from purchasing, a single family flip?
It's harder for several reasons. One is normally the minimum investment is higher than $25,000. I don't want 50 investors on a deal. So the minimum investment is higher, and that disqualifies a lot of people who either don't have that money or don't want to invest that kind of money. Second of all, it's a longer hold period. It's normally I tell people 5 years until we either sell or refinance. So it's much longer than 6 months. And a lot of people are not comfortable with that. And third, it's a more complex transaction. There's much more paperwork involved. There's operating agreements. There's private placement memorandum. There's attorneys involved. And normally a confused mind says no. So for those three reasons, it's harder to raise money for apartment buildings.
Yeah, no, that makes perfect sense. And what about finding those deals? Have you found it harder to find those deals? Is that why you're going to different locations, different areas?
Yeah. It's clearly in this market right now. It's definitely fairly hot because of the current stock market. A lot of uncertainty in the market. A lot of people are putting their cash on the sidelines, and when you tell them you can put your money to work for 10 or 15% over the next 5 years, they're like, okay, tell me more. There's a lot of cash on the sidelines. A lot of people are willing to overpay to get that certainty and that stability. There's also a lot of foreign money chasing U.S. real estate. And so it makes it difficult to get stuff that's listed, kind of like it was in 2005 and 6 in a single family house market where really investors were, we're not looking in the MLS anymore. And so that's kind of what we're doing now is, we're really going back to the old days, meaning, 2005, 6, where we had to get deals through sending letters, postcards, networking, knocking on doors. And we kind of got lazy over the last decade because there was such a great supply of real estate. And I think we got lazy a little bit. People say, oh, you can't, that just means it's not laying around anymore, which means you actually have to work a little bit. And so I think that's what we need to do is we need to start working at it a little bit more, like we did, a decade ago.
Right. Well, I always tell people if everybody can invest in real estate and make a bunch of money, there wouldn't be any profits left over. There wouldn't be the great opportunity for those of us who do it, who put the work in and can find those deals.
Right.
Cool. So I keep hearing you say private money. Do you ever use bank financing?
Yeah, yeah, absolutely. Especially, real estate is really the only business in the world that you can get bank financing for. On the restaurant side, that's an all cash deal. There's no bank that's willing to loan on a restaurant or any other business for that matter, unless you have real estate as a collateral, which again is real estate. So this is why I love real estate, apartment buildings specifically, because you can get an 80%, sometimes more from a bank financing, and it's almost free. 4.5%, it's like free money. It's ridiculous. So I just love the leverage of what you can do with that. It's just such a unique thing.
Yeah, no, I completely agree. So walk me through a multifamily deal. It sounds like you get, find the deal, you get your private money investors together, and then how does the syndication work? How do you make your money? How does it all come together?
Yeah, good question. First of all, the raising money part starts way before you get your first deal or any deal under contract. That's the first thing, because you have a chicken and an egg problem. And it goes something like this. I can't put a deal under contract because I don't have my investors. So I can't put a deal under contract. Or, I'll put a deal. I have a deal under contract, and now I don't have enough time to raise the money, which is also true. So what do? Well, I'm stuck, and I'll give up. Versus what I'm doing in the multifamily is the same thing I did with the house flipping when I first got started. I make up a deal. I literally make up a deal. I will create a business plan, pro forma financials, projections of a real deal with the real photographs and real financials, and everything about the deal is real except that I don't actually have it under contract. But I use it as a conversation piece to start reaching out to potential investors, and I say, hey, here's what I got going on. I'm really excited. Here are the potential returns, some of the risks. Let me show you what a deal might look like. Are you interested? They go, yeah, let me find out a little bit more about that. And you address their concerns and objections. You build a relationship with them. And at one point, they say, I'm good for $100,000. Just let me know when you get a deal. And you stay in touch with them until you actually get one under contract. Then you create an investor package that substantially looks like the one they saw before. So when they get it, it looks about the same, but the pictures are different. The numbers are a little different. And they have a comfort level and they can quickly say yes. So essentially, you get your verbal commitments up front for either all the money you need or, let's say at least 75% of that. And now, so that's the work you got to do beforehand, because it would be very stressful. And some people do this, and God bless them. They will actually put a deal on a contract and then they go raise the money. And they hit the phones and they get it done by the skin of their teeth and they write a book about it. And that's great. I'm not a last minute guy. I like to reduce my stress in my life. So at least, set myself up for success where I have at least most of the money, if not all of it, verbally committed up front. So when you get something under contract, the first thing you do is you create your investor package and you send it to investors and say, hey, I got this deal. You said you were in for $100,000. Are you still good? Yes or no, in for more, in for less. That's great. So the next step really is that you're going to get an operating agreement for your review. You're going to review that and you have to sign it. You're also going to get a private placement memorandum, which is a really long, boring document that discloses all the potential risks about the deal, about the tax consequences, about me. You don't have to sign it, but it's just, you don't even have to read it. I'm required by SEC laws to give this to you. You can throw it in the trash if you want or read it, whatever. And there's a subscription agreement that says that they're investing a certain amount of money and that they're either accredited or non-accredited investor. And again, to address some of the SEC requirements. And the most back and forth happens on the operating agreement. And that operating agreement governs the rights that the investors have versus what you as the general partner, for example, have, what kind of voting rights they have, what you can do, what you can't do. And so that really governs the relationship. And that's the important piece that they have to review. And sometimes there's an attorney involved to review that document. Once everything is signed, then they have to wire the money to the closing attorney, where just like to do in a single family house. And then the closing attorney disperses the funds. So that's how the closing happens. I think your other question was how you pay yourself on it. Right? Was that your other question?
Right. How do you make money? Because they're investing the money. You're not managing the property, right? You've got a property manager in place. So what's your role in the whole, besides finding the deal? What's your role after you buy it?
Well, your role clearly is you are managing, but you're managing the manager. But look, if your property manager doesn't perform, you're going to have to go out there and replace him. You're going to have to interview. You have to make the rest. So you're managing the assets. It's called asset management. So you're still reviewing the numbers. You're making adjustments. For example, one of my deals, I had to end up replacing my property manager because they just weren't performing. And they just weren't get the job done. There was not really a fit. And so I was spending way too much time, again, micromanaging back there. I was micromanaging the manager, and I was like, daggone it. This cannot be. Everybody told me this was a passive investment. Something is not right. But I knew that if I went to go, because I interviewed a bunch of property managers, if I had to go out now and interview a new property manager, that's going to take time, and I have to get in the car, and I'm going to meet them. I was already kind of counting the passive income, but you're just not getting the job done. So there's actually work on managing a manager and reviewing the numbers and making certain adjustments. So my conclusion, Mark, is there's no such thing as a truly passive investment. And I've made the mistake on the restaurant side. I sat in my ivory tower for probably 3.5 years where I didn't go to a single restaurant. All I did was, meet my multi-unit guy once a week for lunch and, pat each other on the back. And I completely went radio silent on the restaurants and bit me in the butt. Real hard. And it's the same thing can happen on any investment, whatever you have. It is passive to a degree, but it can't be so passive that you don't know what's going on and you're completely in silent mode. So there's a lot of work that you've done leading up to this, and there's a lot of work that you need to do during it. So you deserve to be paid in various points of the deal. The first one is when you buy it. You pay yourself an acquisition fee between 1% and 3% of the purchase price. So if you do $1 million deal, with a quick math is $30,000 or so. So it can be a nice payoff. But really, if your investors have a hard time with this, you can educate them a little bit about what happened for you to get to that point, which is you probably looked at 100 deals before that one. Literally analyzed 100 deals, maybe made 20 offers, got really close on 5 of them, and you actually end up buying this one. And if you calculate the hours spent up to this point, you're working for minimum wage, frankly. So you deserve to be paid to get up to this point, number one. Number two, you can pay yourself an asset management fee, which kind of is normally either a percentage of income from the property or percentage of the assets or the equity that was invested. You can slice it either way, 1 to 2 to 3% of that. And that really compensates you for the work that you're doing while you own the asset. And then there's a disposition fee. Again, 1, 2, whatever percent of the purchase price whenever you return the principal. So if you do a cash out refinance and you return all the principal to the investors, the risk is off the table. You get to be paid, you deserve to be paid for that. But having said all that, so those are different ways you can pay yourself. But having said that, the deal has to be driven by the investor returns. They're the number one priority. So if you pay yourself at the expense of the investors, it's a bad deal. You know, if you don't pay yourself at the expense of investors, it's not a win-win, but at least you're in the game and your investors are making the money or the returns and you're building a track record, right? But the worst is that you pay yourself, you know, an asset management fee while the investors are not getting any distributions at all. It doesn't look good at all. It leaves a bad taste in the investor's mouth, and you know they're going to get disgruntled and may not even want to invest with you in the future. So you have to make sure that when you structure a deal, try to pay yourself, but make sure that the returns are still there for the investor.
No, that makes sense. I wasn't trying to say you didn't do any work, you didn't deserve that money, but just curious how you get paid. And then one thing I'm curious too, you know, with the flips, you would pay the investors 12% interest no matter what happens, right?
No matter what happens.
On the multifamily, you're paying them a return based off what the property makes instead, right?
That's right. But again, it depends on how you structure the deal. You can structure a deal where they get a preferred return of some amount. So let's say I agree to pay them a 5 preferred return, and then we'll do a 50-50 split above and beyond that, for example. So that 5% is essentially like an interest payment. That's, you know, quote, guaranteed, regardless of how the property performs. And then whatever's left is then split 50-50, right? So it depends on how you structure the deal. You know, the investors always like preferred return, and the preferred return, though, is not good for you, because if the property is not going according to plan, and all you're doing is paying out the preferred return, if you don't pay it out in 1 year, it accrues and defers to next year. So you get deeper and deeper in the hole, and you actually never get paid anything. So it's great for the investor, but not really that good for you.
Right. And then what about ownership? So when you do this deal, are you the sole owner, or do the investors have part ownership as well? How's that work out?
Well, there's ownership and there's control. They're two different things. So let's say on a standard deal, I might give the investors 80% of the equity for putting up all the money. And I get 20% simply for putting the deal together and managing it and making sure everything goes well. You know, depending on a deal, 10 to 30% should go to you. So they are, in fact, majority owners. But depending on how you structure your operating agreement, gives them limited control. So I have one deal that, you know, essentially my friends and family, and they have no say whatsoever. I mean, I can do whatever I want, how I want to do it, and they have no say in it. Okay, I can sell the building or refinance. I can whatever. I can do whatever I want, and they're fine with it because they trust me and they trust I'm doing a good job. But I have another deal that are more sophisticated investors, and they want more control. So I have a sandbox that I can operate, and I can't hold back more than a certain amount of reserves. I can't borrow more than a certain amount. I can't sell it without a vote. I can't refinance without a vote. If I commit some kind of fraud, they can actually vote me off the island and take control of the asset. You know, you can do it if there's a default situation, they can take over, right? So if you default on any contract that's defining the operating agreement, they can theoretically, by a vote, literally, you know, it all depends on what the investors, whatever the investors want. So is equity versus ownership, and they don't necessarily have to be the same. It all depends on how you structure the operating agreement.
No, cool. Interesting stuff. I know it can be complicated, but very interesting on how you set those up. I am curious, what type of buildings do you typically go for? Are you going for older buildings, newer buildings? Are there certain unit sizes you look for, or just whatever makes money?
Well, it depends. And the answer to this question is going to be different for everybody depending on where they are, right? So if you're a newbie investor, you're looking at, you know, anything from, you know, duplexes, quads up to maybe a 20 unit. And if you're a more seasoned investor, you're going to look for something a little larger than that, right? It depends on where you are. With regards to opportunity, the ones that you're looking for a certain kind of opportunity because it's one of the only ways you can get your returns. which is value add opportunities. So what's a value add opportunity? A value opportunity is something where you can do something to raise the overall income of the building, which in turn then raises the value of the building, right? So the higher the income, the higher the value. And the reason for that is, especially because it's a relatively hot market now, if I'm buying something at a fair market value, I can't achieve the returns for my investors and still pay myself. So I can't do deals like that. But if I buy something at fair market value and it's an underperforming asset, meaning that the rents are maybe low, the expenses are high because there's renovations I should be making so I can raise the rents, or maybe the rents haven't been raised in 10 years and they're just low. And if I go in there and I do some stuff because I'm an entrepreneur and I need to do stuff, I need to improve stuff, I raise the income and therefore I raise the value. Then when I refinance and or sell, I now can have a higher return. And that's how I can achieve the returns for the investors. Or I buy something at a really high cap rate, meaning I'm getting something cheap. I'm getting something at a discount, kind of like you do on the house flipping side. You're getting something cheap, and you get lucky every once in a while, where you just happen to get a motivated seller and they're willing to let it go just so they get rid of it. Those are rare. I mean, you can still get them, but those are rare. I can't build a business around that. Even on the house flipping side, you always had to do something to the property. You always look for the deals where you go in there and you put some, lipstick on the pig and you sell it and you make a bunch of money. That's great. But really, you're still going to put between $30,000 and $50,000 into a house flip, and you're really doing a deep cosmetic, maybe even some exterior work. You still got to do something to it. And it's the same thing with multifamily. Normally, you got to do something to it. That's just the nature of the business.
No, that's good stuff. And yeah, it's a completely different beast, but a lot of the things are similar versus with single family versus multifamily. I have a question for you that I'm sure many people are thinking right now. So if someone wants to get started investing in multifamily, whether they've done single family, if they've never done any kind of investing, do you think they should start out very small with like a duplex, a quad, like you said, maybe even house hack where they live in one unit and rent out the others? Or do you think it's feasible for them to go after a 10 unit, a 20 unit property if they haven't done it before?
Yeah, I get this question a lot, Mark. So my advice is no, don't start with a little quad or duplex. Don't do that. Don't go. Really stretch your comfort zone and try to do the biggest deal that you can. Let me give you an example. When I first bought my first 12 unit, and this was after I'd flipped 20 houses at that point, and I got this thing on a contract, and I went to this property, and I was just totally overwhelmed. There was a 3-story brick building, and it looked like it was going to crush me. I just couldn't bear the idea of what I needed to do next. And so I just kind of sometimes do things. You have to overcome your fear. And I just started doing it. I just followed my due diligence checklist and I did what's on there. An amazing thing happened after about 10 days. I had reviewed all the rent rolls, the financials. I had visited the property several times. I met with contractors. I'm calling the lender. I'm doing all this activity. I'm becoming more and more familiar with this building that for me was unfamiliar. And within about 10 days, I wished it was a bigger building. And because for 2 reasons. One is my comfort zone expanded rapidly in that time period because I became comfortable with this building. I was in it, looked it up, I poked at it, I kicked it, I talked to people about it, I looked at but at the same time I realized that it was as much work to do a 25 unit building as it was a 12 unit. And literally the same amount of building, the same amount of work. So the only reason someone wants to get started with a smaller building is because they don't have a comfort zone to get beyond that, because they're coming from where they are right now. And if it's a single family house comfort zone, then the next step is obviously a duplex. I mean, that's the next step to go. There is no other step to go. But my argument is, and this is what I tell my students as well, you can go through this mental exercise of this sample deal package, for example, that I talked about. Create a sample deal package. And the only way you can create a sample deal package, an investor package, is if you go find a deal, you request a marketing package, you read it from cover to cover, you visit the property, you request the financials, you analyze the deal, you create these financials and the projections, and literally you're spending maybe 4 or 5 hours, maybe even a little bit more, really kicking the tires on this one deal. And if you do that, all of a sudden at the end of this exercise of never having on a contract at all, but simply dealing with it, all of a sudden your comfort zone expands. And if it doesn't expand to the 15 unit or 20 unit, you do it again, and you do it 1 or 2 or 3 times, and all of a sudden you're like, 20 units is not so bad. It's not so bad. And why? And if you hadn't done an exercise and you had done the duplex route first, I mean, you could have done 2, 3, 4, 5 duplexes because you had it in your mind that that's the route you're going to do. And we as entrepreneurs, we're focusing. We're focusing on that, but really it was a total distraction. So yes, you maybe did a duplex in the next 6 months, but really in that time you lost 6 months of actually expanding your mind and looking for that 20 unit, right? Because all you need is that one deal. Is that one deal. And so do the biggest deal that you can, but just work actively in the way I described to expand your comfort zone. And you don't necessarily have to go through, a small duplex or quad to get that.
No, that's awesome. I can tell you're all about attitude and mindset and really going after things too, not staying in your comfort zone. And just like you said, it's easier to do the small deals, but if you don't have to, why?
That's right. Now, unless you have a duplex strategy, okay, there's nothing wrong with any strategy whatsoever, as long as it's an intentional thought. And like I'm saying, a lot of people just do it because without thinking, or that's what people tell them. But really, if you think about it, if you look at how am I going to spend my next 12 months, right? Is it by picking up 4 duplexes, which is going to take me all year, even if I've worked really hard? If I pick up 4 deals the next year, that's a lot. Or do I spend that 12 months to pick up one 15-unit deal? Because I can tell you, once you do a 15-unit deal, you're not doing a 15-unit deal a second time around. You're going to do probably a 50-unit deal, all right, in year 2. So now you're at 65 units in 24 months, and you're at, I don't know what you are, maybe 10 units on the other side. Now you'll eventually wake up from your duplex strategy and go, oh man, now I'm finally ready, but I already wasted the last two years on this. And you maybe didn't have to do that. It all depends on what your goals are, No,
that's great. That's awesome. And I noticed you mentioned your students. You have a great website, themichaelblank.com. So tell us a little bit about your website, about what you're doing over there, and how you're helping people.
Yeah, I mean, I was asked about 3-4 years ago about how to go about raising money and how I put the deals together, and I was like, man, one day maybe I'll put some of this together, and and I was asked to teach about apartment buildings at my local RIA, and I did an all-day Saturday. It was really well attended, and it was really encouraging to me. And I think I have a little bit of a passion for teaching. I really enjoy it, and so I said one day. This was like 3 years ago. One day, you always say one day. And then one day, I thought about that experience, and I was like, you know what? I think I'm going to do it. So I started writing about, blogging about apartment building investing with a special focus on raising money, and put up the website, themichaelblank.com, and I put out a free ebook that's called The Secret to Raising Money to Buy Your First Apartment Building, and started blogging on the Bigger Pockets. So I'm in year 2 of being a weekly contributor, like you have been as well. And not easy to write an original article every single week, as you know. But I also have a podcast like you do, and a YouTube channel. There's a lot of free information on the website. So it'd be a good place for people to start if you want to raise money for really anything, but specifically for apartment buildings.
No, great stuff. And yeah, you have a lot of great resources on there. And I think anybody who listens to this podcast can tell what you're talking about when it comes to multi-unit and putting big deals together. So great stuff. Awesome. Well, I think that is everything I wanted to cover with you. Do you have any parting advice on for people looking to get started in multifamily? What's the most important thing they can do if they haven't invested yet and are thinking about getting started buying multifamily properties?
Yeah, I mean, the biggest thing really is taking action, and everybody's first action is, of course, reading a book or doing a seminar, and that's easy, and most people are able to do that. I'm talking about a kind of action that's a little more strategic, that requires a little more reflection on your life goals of what you want to achieve, maybe involving your spouse and family in this kind of decision, and then really committing to a course, a strategy. And if you're committed to that, that means you're not just buying a seminar. And there's people that buy my course all the time, and that's great. But really, as a coach, I want someone to change their life. So I don't want you just to buy my course. I want you to actually apply what's in there. And I see a lot of drop off between that step. And really, it's because you're not really very clear about the why, the big why. So I want to retire in 3 to 5. I want $1 million. Everybody wants $1 million, right? But why do you want $1 million? What does that mean to you what will that allow you to do? What is a meaningful thing to do? Is it to pay for college for your kids? Is it to leave a legacy? Is it so that you can do something more meaningful in life? You have to be very clear about that. And when you're very clear about that, it's much easier for you to actually take continuous action, which is what you need to do. So it's really being clear at what you want and why you want it, and then taking continuous action, not just an action for a short period of time, but continuous action.
Awesome. I love that. Great advice. Okay. Well, that's all I've got. Best place to contact you, I'm guessing themichaelblank.com, your website. Thank you a ton for being on the show. I know I learned a lot. I hope everyone else did too. And yeah, I'm sure we'll talk again here soon.
Thanks, Mark. I appreciate it.
All right. Nope. Thank you very much.